What if I told you that almost everything you're hearing about silver right now is missing the most important part of the story? Some people are screaming that silver is about to crash. Others are saying this is the last chance to buy before a massive breakout. But very few are actually looking at the signals that matter. In the next few minutes, I'm going to show you 3 critical signs that most YouTubers are completely ignoring. And by the end of this video, you'll have a much clearer idea of whether silver is setting up for a brutal drop or a powerful move higher. So stay with me, because this might completely change how you look at the silver market. Before we dive in, if you like deep, no-hype economic analysis like this, make sure you hit the like button and subscribe to the channel. It really helps Empire Economics reach more people who want to understand what's actually happening behind the scenes, not just the headlines. Trust me, you don't want to miss what's coming later in this video. Now, let's talk about why silver has everyone so confused right now. On the surface, the price action looks messy. One week silver pumps, the next week it pulls back. Traders get excited, then disappointed. And this is exactly the kind of environment where emotions take over and bad decisions get made. Most YouTubers zoom in on short-term price charts, draw a few lines, and confidently tell you silver is going to the moon or crashing to the floor. But markets don't move just because a line breaks. They move because of deeper forces, and silver is one of the most manipulated and misunderstood assets in the entire financial system. Silver is not just a metal. It's money, it's an industrial resource, and it's a hedge against a broken monetary system. That's why its behavior can feel so strange. When fear hits the market, silver sometimes drops with stocks instead of acting like a safe haven. That confuses people. They think, if silver is supposed to protect me, why is it falling? The answer lies in liquidity, leverage, and positioning, not in silver suddenly becoming useless. Let me tell you a quick story. During past financial stress events, silver often fell hard at first. People panicked, margin calls hit, and traders sold whatever they could to raise cash. Silver was liquid, so it got sold. But what happened next is what most people forget. After that initial drop, silver often rebounded violently and went on massive runs that shocked even experienced investors. The crash was not the end, it was the setup. And this brings us to the first critical signal most people are ignoring. Paper silver positioning. Futures markets, especially on the COMEX, control short-term price action far more than physical supply and demand. Right now, large commercial players and banks are positioned very differently than retail traders. While social media is filled with fear and uncertainty, commercial short positions have been quietly reduced compared to past peaks. This doesn't guarantee an immediate rally, but it does suggest that the downside may be more limited than people think. When the biggest players start stepping away from aggressive short bets, it usually means the easy downside move is already behind us. At the same time, retail traders are extremely sensitive right now. Every red candle feels like the start of a crash. This emotional imbalance is important. Markets love to punish the majority. When most people expect a crash, the market often does something unexpected. Not because it wants to be nice, but because that's how it extracts the most pain. Now, I'm not saying silver can't go lower. It absolutely can. But the question is not, can it drop? The question is, what happens if it does? And that leads us to something even more important, the cost of production. Silver miners cannot operate forever below certain price levels. Energy costs, labor, equipment, and regulations have all gone up. If silver prices stay too low for too long, supply starts to shrink, mines close, projects get delayed, and that sets the stage for future shortages. This process doesn't show up on a daily chart, but it matters a lot over time. This is where many YouTubers get it wrong. They talk about silver like it's just another trading asset, but they ignore the real-world constraints. You can't print silver. You can't create it out of thin air like fiat currency. And while paper markets can suppress price temporarily, they cannot do it forever without consequences. Now let's zoom out and talk about the macro picture, because this is the second major signal being ignored. Interest rates and the US dollar. You've probably heard that higher rates are bad for silver, and in the short term that's often true. When rates rise, the dollar strengthens and metals struggle. But what happens when high rates start breaking things? We're already seeing cracks. Debt levels are massive. Governments are spending more than ever. Servicing that debt at high interest rates becomes painful very quickly. At some point, something has to give. Either growth collapses, forcing rate cuts, or inflation reaccelerates, forcing central banks into a corner. In both scenarios, confidence in fiat currencies erodes. Silver doesn't need rates to go to zero to perform well. It needs uncertainty, distrust, and instability. And those ingredients are slowly building, even if the headlines don't scream it yet. Think about this. Central banks around the world have been buying gold aggressively, but silver remains largely ignored at the official level. That doesn't mean silver is weak, it means it's underappreciated. Historically, silver lags gold in the early stages of monetary stress, then plays catch-up in explosive fashion later. People who wait for confirmation usually miss the biggest part of the move. Now, here's where things get really interesting. And this is the third signal that almost nobody talks about properly: the gold to silver ratio. This ratio tells us how many ounces of silver it takes to buy 1 ounce of gold. Historically, when this ratio gets extremely high, silver tends to outperform gold in the following years. Right now, that ratio is still elevated compared to long-term norms. That doesn't mean silver will spike tomorrow, but it does mean the odds are quietly shifting. What makes this even more powerful is the psychological aspect. Silver is affordable. When momentum returns, retail investors pile in fast. They feel like they're getting a bargain compared to gold. This creates feedback loops where price gains attract more buyers, which drives price even higher. We've seen this movie before, but here's the trap. Right before those big moves, silver often looks boring, weak, or disappointing. People lose patience, they sell, they move on to something more exciting. And that's usually when the foundation is being built. At Empire Economics, we focus on understanding these setups, not chasing hype. The goal is not to predict exact tops or bottoms, but to recognize when risk and reward start to shift. Right now, silver is in one of those uncomfortable zones where fear and opportunity overlap. So, is this a silver crash or a setup? The honest answer is that it could feel like both, depending on your time frame and mindset. Short-term volatility can shake people out, but long-term structural forces are quietly aligning. The people who win in this market are usually the ones who stay calm when everyone else is emotional. As we move forward in this video, I'm going to break down what kind of scenarios could trigger the next major move in silver, what signs you should watch closely, and how smart money typically positions itself before things become obvious. Stick with me, because the next part ties everything together in a way most channels never explain. And remember, if this video is making you think differently about silver, drop a like and make sure you're subscribed. It helps the channel, and it tells me to keep going deeper on topics like this. Now let's talk about what could actually trigger the next big move in silver, because markets don't move randomly. They move when pressure builds quietly and then releases all at once. One possible trigger is a sudden shift in monetary policy expectations. Even a small hint of future rate cuts or a slowdown in tightening can change sentiment fast. Silver doesn't wait for official announcements. It moves on anticipation. By the time the news is obvious, the price has already adjusted. Another trigger could come from stress in the financial system. It doesn't have to be a full-blown crisis. It could be a banking issue, a credit event, or even a sharp sell-off in equities that forces central banks to step in. Every time liquidity dries up and then gets re-injected, hard assets benefit over time. Silver reacts slower than gold at first, but when it moves, it tends to move harder. There's also the industrial demand side that most people underestimate. Silver is critical for solar panels, electronics, medical equipment, and emerging technologies. Governments are pushing green energy aggressively, and silver plays a key role in that transition. This demand doesn't disappear just because the price goes down for a few months. In fact, lower prices often increase industrial buying. That creates a silent floor under the market that paper traders rarely talk about. Now let's address the elephant in the room: manipulation. Yes, silver has been manipulated for decades, but here's the part many people miss. Manipulation doesn't mean price never goes up. It means price is controlled until it can't be anymore. Every artificial suppression builds pressure. When that pressure releases, moves tend to be violent and fast. That's why silver rallies often feel sudden and shocking. There's very little warning. This is also why timing silver perfectly is almost impossible. People wait for the perfect entry and end up never entering at all. Smart positioning is not about perfection. It's about understanding zones of value and risk. Silver doesn't reward impatience, but it can punish hesitation just as much. Let's talk psychology for a moment, because this is where most investors fail. When silver is exciting and everyone is talking about it, risk is usually higher. When silver feels frustrating, boring, or disappointing, risk is often lower. Right now, sentiment is mixed at best. That's not a bad thing. Extreme optimism or extreme pessimism are the real warning signs. Indecision and frustration are where setups form. Think back to previous silver cycles. Before major rallies, silver often spent long periods going sideways, shaking out weak hands. People called it dead money. Then suddenly, it wasn't. Price exploded, headlines changed, and late buyers rushed in. The same people who mocked silver at lower prices suddenly couldn't stop talking about it. Another important piece of this puzzle is physical silver demand. While paper prices move up and down, physical buyers tend to think differently. They buy dips. They think long term. Premiums on physical silver often stay elevated even when spot prices drop. And that tells you something important. It tells you real-world demand isn't as weak as the chart might suggest. At Empire Economics, we always separate noise from signal. The noise is daily price movement and emotional reactions. The signal is positioning, macro pressure, supply constraints, and long-term trends. When you line those up, silver starts to look less like a random gamble and more like a strategic asset. Now, let me be clear. Silver is not a get-rich-quick trade. It requires patience, it requires conviction, and it requires the ability to sit through volatility without panicking. That's why most people fail with it. They buy too late, sell too early, and blame the asset instead of their emotions. So how should you think about silver right now? Not as, is it going to crash tomorrow? Or is it going to the moon next week? But as, what role does silver play in a world of high debt, currency debasement, and systemic risk? When you frame it that way, short-term moves become less scary and long-term positioning becomes clearer. As we get closer to the end of this video, I want you to ask yourself one question. If silver really was useless, if it really had no future, why does it still sit at the center of both industrial demand and monetary history? Why does it react so strongly during times of stress? And why do powerful institutions work so hard to control its price?